Okay, we are back. Investments. So we've got to remember superannuation is just a tax structure, or a tax structure rather. So what most people will have their super in, and this is just from the ART website, full disclosure, ART have worked with us before, so why wouldn't I use them as an example? They haven't paid for this, but, if we have a look here, most people will have a portfolio that has a blend of assets, right? And it's important to note that in the super world, there's like almost $4 trillion of a super in Australia. We're on track to be the second biggest retirement pool in the world. The trustee and / your super fund, they'll manage the money, do all the tick boxes and all that, and then they'll also invest the money for you, the member, and you can choose what you want to invest in. But I just wanted to park here and show a couple of examples. And whatever super fund that you're with or you're looking at, their website will be similar. It will tell you potentially the investment options they've got, the suggested hold time or the time frame. It will tell you the fee, and we'll get to fees shortly. Over the last 10 years of growth, when you see returns in the super world, everyone, it's after fees and after taxes, okay? So in theory, 0.79 over 10 years for the high growth option, you could add 0.7% to get the real return pre-fees. And you can see here how it says retirement income accounts.
Yep.
So because accumulation account is the account that's taxed at 15%, the same investment option in the pension account, which had 0% tax, did 9.61%. Okay, so you can see the difference there. 9.61 take away 8.79. So there's probably 0.8 in tax.
Yep.
So yeah, you'll see all this stuff on most sites. You'll see here their asset allocation, what they've got allocated to Australian shares, international shares. Now in the super world, it is a little bit different. Unlisted assets and alternatives, that's going to be things like shopping centres, it could be toll roads, it could be alternatives, could be some private equity company. So when we have a look here,
based on my last trip, I wouldn't mind investing in toll roads.
Really? Yeah.
Outrageous.
Oh, yeah, it's expensive. So basically this fund, it says here, the high growth performance, if you want a diversified portfolio with around 85% of growth assets. So if we have a look here, there's probably about 65 in Australian and international shares. There's probably 20% of this unlisted and alternative here that is considered growth. So they might have some assets that are infrastructure assets that are considered defensive because they really don't change in capital nature. They're just, pay your revenue. So you'll see here with the super funds, it will tell you the standard risk measure. They reckon between 4 to less than 6 years, this high growth option will see negative returns in any 20-year period. It will tell you the investment objectives. So they really want to target 4% plus CPI. So if we have a look at if CPI is 3%, that's 7 in total. Well, we know here they've smashed that objective over the last 10 years because it's 8.79.
Okay, so this is an example in the high growth column. Where can we go with that? Would you say high risk is riskier?
Well, by the definition, higher growth is higher risk. And higher growth, we need to hold longer to cater for market cycles.
So someone in their 20s and 30s could easily say, yeah, give it
I think
growth.
If you're under 50, there's a strong argument that you need to get to, you need to understand this more and get to maybe an 80% growth. Because even if you're 50, you've still got 10 years before you can really access the money.
Yeah.
And if the minimum hold time is 7+ years, well, it's time to get educated. It's time to understand. There could be some strategies, and we'll cover this later because it's going on the scope of what I want to talk about. But there could be some strategies where if you're 50, you might put the money in high growth, and all new contributions just go to cash or So
in this example, we're looking at about 97% high growth. Cash and fixed income, you'd say, is the low risk?
No, because there's going to be 10% of the unlisted assets and alternatives that are considered defensive.
Where does it say that?
Well, it doesn't. I'm just kind of working out. They say that this portfolio is 85% growth. See that there?
Gotcha, yes.
And then here, if we add 30 Australian shares, 33 Australian shares,
65,
gives us 65. The 20%.
Gotcha.
It can't come from cash or fixed income.
No.
So there's 20% coming from here, which is the unlisted assets and alternatives.
Okay. So if I want 90%, for example, then I'm going to very high growth.
Yeah. So there may be a fund that has an asset allocation to a 90%. And actually, a lot of people say, if we have a look at this next slide, we are doing an episode. It probably will be up, if not in 2 days' time, right after this, on self-managed super funds. In fact, I think it pretty much will be. And we're just going to go through, and one of the common things is, well, I want to invest in ETFs, so I need to get a self-managed super fund.
Yeah.
Well, you don't, because even here with, again, ART, and every fund will have these options, you can choose an Australian shares index option. So that's 100% of your investment would go to Australian shares. And you'll see there that it just tracks the return of the MSCI Australia 300 index. So,
but I suppose where they're going with that is they don't have full control of where that actually goes.
Well, if you bought an index fund that was VAS, so Vanguard Australian shares, that invests in the top 300 Australian companies listed on the Australian Stock Exchange. You set that up in your personal account, in your app and all that. People are like, well, I want to set up a self-managed super fund so I can invest in ETFs. Well, if one of your ETFs is going to be VAS, go to your current super fund. This tracks the same benchmark, basically, as VAS.
Yeah. So if you've got one ETF that you want to concentrate on, go for it.
So what you could do, you can see here the fees cheap because it's an index fund. You could select in your super fund, I want to invest in the Australian shares 50% and 50% international shares. And what you can do, and I've put this in here because people want to build their own portfolios in their super. You really don't need a self-managed super fund. You can do that with most funds. So if we go international shares, you'll see that the benchmark is the MSCI All World ex Australia. So that's equivalent-ish to a VGS. So you can get the exposure that you can outside in ETF land with your current super fund. This one here on ART, these are some of the individual options that you can use. Australian shares index, international shares, hedged, unhedged, listed property. So you might have VAP as an ETF in your own name. If you had a look here at the listed property, I haven't got it up here, it would actually show you what it tracks. And it would be, I can tell you now, very similar to that of the VAPs. If you want to list in their unlisted pool, you can do that. And then they've got bonds and cash. So all that to say, most trustees and most super funds have really a decent amount of flexibility.
Yeah. So the obvious question when we look at that is, well, I might be sitting outside of my super investing in ETFs and choosing how much money I'm putting in each month, dollar cost averaging different ETFs. I might have 7 ETFs set up. am I looking at that and saying, well, okay, because I've got that outside of my super, I'm mixing it up inside a super, or am I just staying consistent? Like there's no one size fits all, of course, but how does someone need to get that into the weeds about it?
I don't think so. I reckon most of the pre-mixed options with most major funds, they're around the same cost. And you can have a look. Actually, coming up on the This Is Investing podcast, a lot of people always ask, well, what portfolio percentage should I use? I've prepped an episode to record that I look at most of the top Australian super funds, look at their asset allocation, and then I built my own portfolio based on averaging out all the top fund pre-mixed options.
Right.
And, very interesting, the outcome. So I think a lot of the pre-mixed options are fine because we know if, investing works, portfolios work, people don't.
Yeah.
And, if you did want to invest in 50% international shares, 50% Australian shares, and I'll show you here in a minute, John, the fees are cheap, the performance is decent looking back, but you probably won't be able to stomach a downturn.
No.
Where the premix options have unlisted property, they've got infrastructure, they just will give you a smoother return. So I don't think people need to overcook their superannuation investment choice. So let's have a look at fees now. There are basically 3 types of fees in most retail or industry funds or public offer funds available. There is generally a dollar-based admin fee, a percentage-based admin fee, and then a percentage-based investment fee. Okay? So if we have a look here, I've just put a small example together. With ART, the admin fee is $1.20 per week or $62.40 a year. The percentage-based admin fee is 0.1% of your balance, regardless of what it's invested in. And once you've got over $500,000, it caps out at $500 a year. And then they've got the investment fee. So that is the fee for the high growth option that we had a look at previously.
Right.
So I want to show people here how to calculate your superannuation fee, and I'm going to walk you through it. Remember, fees aren't everything, but they're something, and it's good to know. You first have to annualize the admin fee. So we need it to be $62.40. Then we want to get the dollar amount of the investment fee and the admin fee. So if someone here had $63,000 in their super fund, it's a $62.40 flat fee. The percentage fee of the admin is $63. The investment fee of 0.7% is $441. Remember, that's not taken out of your account. You won't see that in the statement. It's taken out before they give you the investment return.
Gotcha.
Remember that table I showed you with 8 point whatever percent? That's after the 0.7 had been taken out.
Yeah, but not the admin fees.
But not the admin fees. So what you basically do then is we add the $3 figures together, which is $553.50. And then I've written this out if you want to take a screenshot or remember this. It's really easy to put in your calculator if you're, mathematically challenged like I am. $553 divided by, so your total fee in dollar terms.
Total balance.
Total fee divided, total fee divided by the balance.
Yep.
Divided by $63,000, it will give you a 0.0009, blah, blah, blah. Mm-hmm. Then just press times 100 in your calculator and it will round it down to 0.90%.
And those 3, the $1.20 per week, the 0.10% and the 0.70 based investment fee, would you say that's standard across most funds?
Yeah, most of them you'll come in at under 1%.
Okay.
Now remember, fees are not everything, but they are important. I think anything over that 1% in total, you'd want to be really sure that you're getting something back for that.
Yeah. And
Some super funds I know might be 1.1%, which I think is a bit rich. But look, and I'm going to show you the next page if you want to build your own portfolio, like we talked about, what the fee does. But there's as an example, the Host Plus, which is, nothing wrong with Host Plus or the fund or anything like that. They've got a balanced indexed option, which has got Australian shares, international shares. It's all indexed. It's really cheap. And then they've got their default option, which has got Australian shares, international shares. It's got property, unlisted. Now, that's more expensive. But after fees, you would have had more money on the table with the expensive option.
Yeah, right.
Okay.
I don't get into these weeds much. Someone else does this on my behalf, gratefully. I wouldn't be changing super funds based on the fees.
No, and you don't want to. And for example, Johnny, before we hit record, John said your super and AIM is on the Net Wealth platform, which is through a financial advisor, and they've got a portfolio that they've set up, blah, blah, blah. You will have these fees on Net Wealth. There will be a percentage-based admin fee. So regardless of what you invest in, if you rock up and put $200,000 on our platform or in Australian Retirement Trust or in Australian Super, Rest, Host Plus, anything, you rock up and put money on our platform, there's a fee.
Yeah.
Then you'll have an investment fee.
If there's not a fee, there'd be a concern, right?
Well, yeah, pretty much.
No one's working for free.
Yeah, and I will say, old wives' tale, there are no built-in hidden commissions in any investment product or super product in Australia anymore. Everything is disclosed and upfront.
That went out.
So let's have a look at the next slide. Here is the fee calculation. We won't camp on it long. If we had 50% Australian shares and 50% international shares unhedged, the fee's 0.08 because it's not actively managed, it's just automatically tracking an index. So 0.7 versus 0.08, the fee becomes in total 0.28%.
Right.
Okay? So a decent saving, but the question is, if you did this portfolio, you really can't compare the high growth because now your asset allocation is different. And this is where we need to have a cold shower when it comes to comparing super funds. You really can't say, well, my super fund is 0.28. Why are you paying 0.90? They're completely different investment options. And not only that, when you are comparing, so if you had Australian super high growth and ART or Aware Super or Rest Super or Uni Super, high growth, any of these companies, before you compare the fee, you have to line up the asset allocation. So what percentage is in Australia, what percentage is in international, what percentage is in property, because you need to be comparing apples with apples.
How many Australians would be looking at this stuff and saying, these are my fees? And
Probably just the two of us here.
Yeah.
A couple of freaks and geeks out there as well.
Because it's pretty minor in the whole scheme of things, isn't it?
Yeah, like I honestly, if someone was just like, I'm happy with the high growth here, 0.7.
Yeah.
I'm happy with the super fund. I like their website. I like their app. Freaking get on with it and just shovel money.
And when you say like their website, might be an off-the-cuff comment, but what do we want to see on a website? Do we want ease of access?
Well, it might be their member portal is easy. They've got a nice app.
Yeah.
If I want to do a notice of intent to claim, they don't make me use a wet signature. Yeah. If I want to do a spousal split, I can do it to an external fund. It doesn't have to be the same fund. I'll go out on a limb. Most of the big super funds in Australia, they're going to be around the same fee and the same return. It's honestly just the vibe, for want of a better word, I think. And you can at me in the comments and all that, that's fine. But we've got a really good, robust super system here in Australia. So let's now have a look, John. We see it online when people ask questions, what is not a superannuation fee? Well, the first thing that isn't a superannuation fee is the contributions tax, because whatever different super fund you've got, could be CBUS, Australian Super, Aware Super, Uni Super, ART, Rest, Host Plus, some other super fund that no one's heard of, or you've got a self-managed super fund, you've got to pay the contribution tax to the government. So that's not a fund fee. The other thing that is not a fee is the insurance premiums, because they will vary, but with every separate person.
And there needs to be insurance premiums in there. That's
Well,
a priority.
No, I think that we'll get to we've got a whole section on insurance, but I just want to say when comparing super funds, you really can't look at the insurance premiums.
Yeah.
Because you want to keep your insurance separate to your wealth accumulation.
Yes.
You don't shat where you eat, John.
No, but what I'm saying is they come hooked on to every superannuation.
Yeah. Well, you can opt out and turn their default up, and we'll get to that. But strictly speaking, when you're comparing super funds in terms of fees, you just want to look at the admin fees and the account member fees and the investment fees, and you've got to make sure the investment fees that you are comparing lines up with a similar fund that has the same or very close asset allocation.
Yeah.
So another trap there, there's no real industry law to say that a high growth fund must have 80 to 90% high growth. So in the non-super world, a balanced fund will have 50% defensive and 50% growth. But in the super world, the word balanced could go, our balanced fund has 70% growth and 30% defensive.
And that's the confusing part about it for someone that's not in there day to day, is you look at balanced and you look at growth and you're like, hang on a minute, these results are very similar.
That's right.
What's happened here?
Yeah, and
that was meant to be conservative balanced.
And you could actually look at stuff and it's like, far out. This super fund's balanced option that has a lesser allocation to growth has done a better job over the last 10 years than this fund with a growth option that has 80% to growth.
Yeah.
Something's going on here. Fund here that has a higher growth allocation.
Yeah.
Maybe they're crap managers.
Yeah, I was going to say they're investing in the wrong assets.
Or the other super fund, maybe there's some stuff that they're flagged as defensive is actually not really defensive.
Yeah.
So
how much do you read into that? When someone says, look, do you want balance? Do you want growth? Do you want what the other categories are? Where do you treat that seriously, or do you say, look, these are the kind of returns I would like?
Well, I think it's important and I want to educate people on having a look at their current superannuation option, seeing what their fees are, seeing what the asset allocation is in their option.
Yeah.
And it will be on the website, or you open your statement or log in, like you're invested in the growth option. Okay, I'm going to go click it, see what it says, how much money is invested in growth assets, shares, international Australian, private equity, property.
Yeah.
And you just got to know, you just need to start to learn what's what in this super world. Hey, it's Glen here. Thank you so much for watching today's video. You made it to the end. Can I ask a favor? Can you hit that like button and maybe hit subscribe if you want to get notified when we release further videos just like this one, whether you watch the Money, Money, Money podcast or Retire Right. And remember, if you want to learn more about investing, I've got an investing book, The Quick Start Guide to Investing, and there's a link in the description to get your hands on a copy. Thank you so much. Bye.